All right. So now we are going to focus on translation, right, of financial statement. What all is required from a financial statement perspective, the rules and regulation around translation. So for your assets and liabilities, right? So when you again think about your financial statements, right? What do we have? We have assets, we have liabilities, we have income, we have expense, and then we have capital, right? These are the five components we have. And then we also have to deal with cash flows, which I said the rules for translation of cash flows are covered in Ind AS 7, which in a way provides guidance for cash flows, including foreign currency cash flows. Okay. Excuse. So when you look at the assets and liabilities, right? Here you're going to use the closing rate. Okay, closing rate. So let's say I have a US dollar as my functional currency and I want to translate that into US dollar. Then I am going to use US dollar closing exchange rate between INR and US dollar on, let's say 31st March is your year end. And as of 31st of March, say 2021, or let's say 20, depending upon your year end or measurement date, whatever is your translation date, you use that date rate, right? Closing rate on the date of translation, okay, or the date of the balance sheet. Similarly, for the comparative period, you're going to use the comparative period closing rate. So if it is, let's say, if you're doing 31st March, here it is March 21, and here it is March 20, then you're going to take the March 20, right? You're going to take the March 20 closing rate, 31st March 20 closing rate for translation for the comparative period, right? Similarly, for the equity items are translated at the historical rate, okay, which are actual rates, let's say. And what does it mean here? Let's say if you have issued share capital, right? The date on which you have issued the share capital, you will do translation using the exchange rate, which is prevailing on that date. Okay. So for example, if you have issued equity share capital on 1st of July, 2020, right? So you're going to use the exchange rate, which is prevailing between INR to US dollar, or as of 1st of July, 2020, right? And then again, for comparative period, you will use the actual rate. So for equity box, in a way, you will use the actual rates. Okay, we use the actual rates. So, and then for the income and expense item, we use the actual rates, but actual rate is generally not feasible, okay, for income and expense item. So what we end up using is the appropriate average for the current period, appropriate average. So if you're doing, let's say, translation on an ongoing basis, you use a monthly average, you use a, monthly average normally is what we see. But let's say if you're doing translation only once in a year, okay, so you can use an annual average as well, assuming that the transactions are happening throughout the year with common frequency. There is a lot of consistency, and there's not a whole lot of volatility in the exchange rate, so as to say that the actual can differ significantly with the average. And if the transactions are fairly consistent through the year, then anyway you will get the actual average will in a way correspond to the outcome, will not be materially different. Okay, so three different types of rate is what we see being used in practice. One is that for your closing assets and liabilities, you use the closing rate. For your equity items, you use the historical rate or the actual rate, and for P&L items, you will use the average rate. And similarly for cash flow also, you will use the average rate. I think that's how the guiding principles are under Ind AS 21. And since you have to tie up the trial balance, right, and if you see that some items in the trial balance are translated at the closing rate, some item in the trial balance are translated using the historical rate, and some item in the trial balance are translated using the average rate. Okay, so there are three different types of rates which are being used to, let's say, translate a functional currency trial balance into the reporting currency or the presentation currency trial balance. And we will try and do this with the help of an example as well. So what it does, it results into a difference. Okay, it results into a balancing number, and that number is called cumulative translation adjustment, or currency translation adjustment, right? Currency translation adjustment, which is what is called CTA. Okay, so to say currency translation adjustment, which is what an exchange difference it results into, which is a separate component of equity. It is recognized as a, it doesn't go into your P&L, it recognizes as a separate component of equity. There are rules around that when it can be, when it should be classified to P&L, which essentially is that when you dispose of those foreign operations, then the currency translation adjustment in relation to those foreign operations also in a way gets reclassified to P&L from that perspective. Otherwise, it stays in the equity box from that perspective. So I hope this is in a way is clear to you. So first we talk about the rules around the transaction related matter, right? So when you are dealing with a transaction related matter, so if it is in the case of a transaction, we said that if you record initial transaction based on the rate which is prevailing on the date of the transaction, the spot rate or the average rate of that day, from that perspective, or of the week, depending upon the volume of the transaction. And then we said you're going to look at, so you look at that average rate, right, or the actual rate, and then we said at the measurement date, right, at the measurement date, you will go to revalue for that payable and receivable based on the prevailing exchange rate and record the gain or loss through P&L, right? For non-monetary item, we said you don't need to do anything, that stays at the historical rate. And then we also said for the non-monetary item where you're doing the revaluation, right, that is where you have to use the exchange rate prevailing on the date of such revaluation. Okay. So that was on the transaction side. Similarly, on the translation side, we're saying that for assets and liabilities, right, you're going to use the closing exchange rate, right? Closing exchange rate for the balance sheet date. Okay, the prevailing for the share capital, share premium and all of the equity matters, you will use the historical exchange rate or the actual exchange rate. For the P&L matters, you will normally going to use the average exchange rate for translation. And then there is going to be a delta, resulting delta, that is called currency translation difference, right? CTA, currency translation adjustment, that is recorded also as a separate component of equity as part of your other comprehensive income, right? That is another component of other comprehensive income. Okay. So I think the guidance which is provided on entity functional currency equally applies to determine the functional currency of foreign operations of the entity. So we talked about how do you determine the functional currency of the foreign operations? You determine the functional currency with reference to the primary economic environment, right? And how do you assess the primary economic environment? We assess the primary economic environment with reference to sales, cost, financing, and my cash flows, right? And again, when you look at sales, you look at the sales in the context of how you which currency influences the sale price, and which what regulatory or market forces are in a way driving your sales price. So there are two elements to look at from a sales price perspective. And then you look at cost of labor, cost of purchase, they are dominated in which currencies. And then you're going to look at your financing, in which currency you're raising your debt or equity, right? And you look at in which currency you are retaining your surplus, right, which is your cash flows. Okay. So you apply that, and then, so the translation procedure, right, for the translating foreign operations are the same, right? There is no difference. So from translation for functional currency to the presentation currency is same across the board, whether it is your domestic operations or foreign operation. And each operation, you need to evaluate the functional currency for each of the legal entity or of a business, so to say, branch, which is out there. And then you got to evaluate the functional currency, and then do the translation into a presentation currency. So you got to bring it all together. Same principles, right? For foreign operations, assets and liabilities are translated at the closing rate, and income and expense are translated exchange rate at the date of the relevant transaction, although appropriate average rate may be used, which is what we see, that the appropriate average rate which are being used. And the resultant exchange differences are recognized in other comprehensive income, right? Which is what is presented as a separate component, which is a foreign currency translation reserve, currency translation adjustment, right? CTA. So, or foreign currency, whichever name you may want to call it, currency translation adjustment, or foreign currency CTR, which is also being called CTA. It is also being called, but it goes and sits as part of other comprehensive income. That's the most important bit. It doesn't go and hit your P&L. The exchange fluctuation, the volatility doesn't hit your P&L. It goes and sit as part of the other comprehensive income. And I'm sure you recollect that what are the other items which goes into other comprehensive income, right? If you're doing a revaluation of property, plant and equipment, or of your intangible assets, or of your other in terms of your actuarial gains or losses, or for your hedging gains or losses if you're doing a hedge accounting, right? And also the foreign currency translation reserve. These are 4 or 5 components in a way which goes and sit into your other comprehensive. These are defined, right? These are defined by rules. So you don't have a choice to say that, look, can I transfer this to other comprehensive income and not take it to the P&L? That choice is not available. These are all defined in the rules from that perspective. And I talked about the cash flows, right? This is defined in Ind AS 7, okay? And cash flows are translated at exchange rate at the date of the relevant transaction, which is again generally not possible. So although an appropriate average rate. So what we again see in practice is the appropriate average rate, right, may be used, and that's what is permitted in the standard. And everywhere, wherever the standard says that you can use the average rate, it comes with a caveat to say that there shouldn't be a significant amount of volatility. So if you have to volatility, then you got to use multiple average rates, for example, right, from that perspective. So you got to be cautious here. If you land up with an exam in the exam and the question suggests that there's huge volatility, then the first is the requirement is actual. You can use average if they are in a way approximate each other, and there is no bright line here, right? There's no bright line here. You got to exercise your judgment, right? You got to exercise your judgment here, and then do appropriate assumptions, right? That's always the case. So in addition to the exchange differences as stated above, right, the foreign currency translation reserve may include exchange differences arising from loans that form part of the parent net investment in the foreign operations, and gains and losses relating to hedges of a net investment in a foreign. I think these are two very, very important points, right? So what we're trying to say, exchange differences, the foreign currency translation reserve may include exchange differences arising from loans that form part of the parent net investment in the foreign operation, and gains and losses related to hedges of a net investment in a foreign operations. Okay. So what does it mean? Let me just try and help you understand here. So essentially what we are saying in this, so what happens, let's say there is a company A and they have a foreign subsidiary, let's say F. Okay, and company A actually has given, let's say, $100 a loan. Okay, I have given a loan of $100 to this my foreign subsidiary. Okay, A has given a loan, so A can fund F in two ways, right? Either I can give a loan or I can give an equity. Okay, let's say I can give an equity of $100 as well, right? So what essentially it is happening. So let's say if this is a rupee denominated loan, for example, or let's say it's a dollar denominated loan, right, from a perspective, from that perspective. So had this been funded in equity, right, had this been funded in equity, then this would have been a non-monetary asset, right? As I said, if it is a equity non-financial asset, then it is an equity, then you don't need to fair value, right? It records at the historical rate unless you are required to do the fair valuation. And as you know, we have the option, right, for under the Ind AS 27 on separate financial statement that we can decide, right, not to fair value my investment in subsidiary. Okay, so if I'm keeping my investment in subsidiary at historical cost, then what's is essentially happening is that if there is a foreign exchange volatility, that also is not getting recorded. Okay. But if, let's say, if instead of funding my subsidiary by way of equity, I decided to fund it by way of debt. Okay. So the accounting standard then says that if the repayment of the debt is not planned in the foreseeable future, what the debt you have given to your subsidiary, if the repayment of the debt is not planned in the foreseeable future, then you should actually treat the debt as a quasi-equity. Okay, you treat the debt as the quasi-equity, and the foreign currency translation gain or loss in relation to that debt, okay, is also allowed to be recorded as part of other comprehensive income. Okay, is allowed to be recorded as part of currency translation reserve. This is only allowed in the consolidated financial statement. Okay. In the standalone financial statement, it is required to be in the standalone financial statement of the parent A, right? It is to be required to be recorded as part of profit and loss account. Okay, as a revaluation gain or loss of a foreign currency loan. Okay. But in the consolidated financial statement, if you take a view that it is actually not likely to be settled in the foreseeable future, neither planned nor likely to be settled, okay, then this is treated as a quasi equity, and then the foreign exchange fluctuation on that is recorded as part of a currency translation reserve. Okay, as part of currency translation reserve from so in a way you offer it the same effect as you will offer it for the investment in equity instrument. Okay, so investment in equity instrument, because they are recorded at historical cost, right? You will translate them, and then it will also go and sit into the currency translation reserve. The same thing is what you will do here for in a way for the foreign currency loan, which is an intercompany loan. Okay, in the consolidated financial statement. Okay, now again I want to further explain, differentiate, and remember, when you are doing the translation, right, for the purpose of presentation currency, okay, for the translation for the purpose of presentation currency, that translation you will do for all assets, whether monetary, non-monetary. Okay, you're doing it for all assets at the closing rate, all assets at the closing rate, all liabilities at the closing rate, all P&L item at the actual rate, but ordinarily you will do at the average rate, all equity box item, which is share capital, share premium, and if there are any other item, that you do at the actual rate, historical rate. Now the retained earning, in a way, because retained earning flows from the P&L, right, it gets recorded at the average rate by default, right? Currency translation, that becomes a balancing number. Other items, that gets translated at the average rate, like if there is actuarial gain or loss or other matters, they all get translated at the average rate from that perspective. So that's how the whole process of translation in a way works. And you get this unique benefit of if you've given a foreign currency loan to your subsidiary, and if there is an exchange gain or loss, and if you wish to treat that as a quasi equity, that is permitted. And similarly, if you have made investments in a foreign currency in a foreign operations, right, and if you were to designate that into a hedge relationship, right, the gain or loss on that hedging instrument, okay, can also be parked in the other comprehensive income. So the hedge, which is what this item was saying, that so there are two items here, right? So one is the from the loans. Okay, loan is item number one here, I would say, and then net investment is item number two. These are two different, in a way, categories of exposure you have in relation to your investment in foreign operations, and both of them, the foreign exchange fluctuation, can be recorded as part of other comprehensive income. So if you're doing hedging, that can also go into other comprehensive income, the gain or loss, and also if you are doing a quasi equity kind of a debt instrument, that also goes to other comprehensive income. Let's try and understand a little bit more on this with the help of an example. So Capital Limited, right? Parent functional currency is GBP, and state GmbH subsidiary. Okay, so I have a parent, Capital Limited, which is a parent. The functional currency is GBP, and I have a German subsidiary, right, whose functional currency is Euro. Okay, Capital Limited, as part of its business, sells inventory to state GmbH for GBP 1000. Okay, I'm selling inventory to GmbH for 1000. Okay, awesome. At the reporting date, state GmbH is yet to make the payment, and it is expecting to make the payment in the foreseeable future to Capital Limited. That means what? There is a 1000 GBP which is outstanding, right? Sells inventory, so I have to receive 1000 GBP, and my subsidiary has to pay me 1000 GBP, right? Now, in addition to the trading balance between Capital Limited and the state GmbH, which is a German subsidiary, Capital Limited has earlier lent an amount of GBP 4000 to state GmbH. So I've given a GBP 4000 to my subsidiary, which is not expected to be repaid in the foreseeable future. So it's a monetary item, right? It's a monetary item. Okay. And inventory, of course, is part of my asset, and then the receivable is a monetary asset, right, in the books of the parent, and it's a liability in the books of the subsidiary. And inventory is also sitting in the books of the subsidiary now, okay, at 1000 GBP, right? So at 1000 GBP, they have to record, of course, the transaction, the functional currency. So on the date of transaction, they will record. Now you are required to determine should the exchange difference be recognized in the profit and loss account or not. Okay, should the exchange difference. So there are two possible types of exchange difference we are dealing here, right? One is on the receivable and the payable, which is this on this 1000, right? GBP 1000. There is a receivable and payable here. So essentially for the parent, it's in GBP only. So they don't have any gain or loss, but the gain or loss will be there in the books of the subsidiary because their functional currency is euro, and you have to pay in GBP. So there is a currency exposure they have. Similarly, for the loan, right, a parent has given a loan of GBP 4000. So parent functional currency is GBP, from a parent perspective, and they have to receive in GBP. There is no exposure of currency. Wherein the subsidiary, their functional currency is euro. They have to pay in GBP, repaying GBP. So there is a currency exposure they are carrying, right? So when you look at the standalone financial statements of the subsidiary, which is the German subsidiary, they need to record the gain or loss in relation to the translation of both the monetary liability in the profit and loss account. Okay. However, when you go to the consolidated financial statement, okay, the consolidated and on inventory, there is no gain or loss on account of foreign currency because that's a non-monetary asset, right? Now, when you now look at the consolidated financial statement, the gain or loss in relation to this 1000 will also flow in the consolidated P&L as well. Whereas the gain or loss in relation to this 4000, right, this GBP 4000, that can actually recast to other comprehensive income, right? Because of this fact pattern that it is not expected to be repaid. Because it is not expected to be repaid, so it is akin to quasi equity, and that is why it gets reclassed to other comprehensive income, right? So if repayment is planned, even if not due, the gain or loss should be recognized in profit or loss. Therefore, the exchange gain or loss on the trading balance, right, should be recognized in profit or loss. So that is what I said, right? On the trading balance should be recognized in profit or loss. For the amount that is lent by Capital Limited, it should be regarded as part of the quasi-permanent funding to state GmbHs. As the exchange gain or loss incurred by Capital Limited loan, GBP 4000, should be recognized in the profit or loss in Capital Limited separate financial statement. It all depends that what currency I have exposure. Do I have to receive this in euro, or I'm going to receive this in GBP? So that will determine in which balance sheet there is an exposure, right? But recognized in other comprehensive income and presented within equity in the consolidated financial statements. That's the important thing, right? You're recording the gain or loss, but the gain or loss is not recorded in the P&L. It is recorded in other comprehensive income. Okay. And the big assumption, if I were to record this in the books of Capital Limited, right, that they will actually receive equivalent euros, right? So they have to they're going to receive, so that is why the exposure is in the books of the Capital Limited and not in the books of the subsidiary. So you should make an evaluation here like this, right? I am a parent and a sub. So what's my functional currency? My functional currency is GBP and my functional currency is euro. So I have a receivable or a payable in euro or GBP. If you have a receivable or payable in GBP only, then you don't have a foreign currency exposure. But if you have a receivable payable in euro, then of course you have a foreign currency exposure. And here, if I have to pay in euro, then I don't have an exposure. Okay, so one of the entity will not have an exposure, the other will have an exposure. Okay, now if you were to transact in a third currency, let's say both of these guys are adventurous and they say I want to transact in JPY, right? Then both of them will have an exposure. Okay, then both of them will have a currency exposure. Okay, JPY is Japanese yen. So let's move forward. Okay, so we've talked about this. Let's take another example. Okay. So modifying the previous illustration, suppose for tax reasons, the quasi-permanent funding is made via another entity in the group, City Limited, on the direction of Capital Limited. So you've done this based on another entity, City Limited, on the direction of Capital Limited. Where should the exchange difference be recognized? So now we have another entity, right? Okay. So let's look at the solution here. Okay. So we have the parent Capital Limited, we have the subsidiary GmbH, and then we have another, and then let's just look at the flow of the transaction. So the parent, the subsidiary, and the GmbH. Now the subsidiary has given a loan of, let's say, 4,000, right? 4,000 sterling pound to subsidiary state GmbH, okay, on behalf of the parent. So any exchange difference in respect of the loan is recognized in other comprehensive income in the consolidated financial statement, because from the group point of view, the funding relates to an investment in a, so answer doesn't change in a way. Answer doesn't change in the consolidated financial statement, but in the standalone financial statement, now possibly the risk has shifted to City Limited. So in the City standalone financial limited, they'll have to record the gain or a loss. Okay. Therefore, if the loan is denominated in City Limited functional currency, and this is different from that of state GmbH, then exchange difference still should be recognized in other comprehensive income in the consolidated financial statement. Okay. It will go into consolidated financial statement. Okay. But in the standalone, as I said, it will go into the P&L as what was explained in the previous example as well. Okay, now we will go through an examination question which was picked up in May of 2019 for 5 marks. Let's go through this. XYZ Limited, XYZ Global Limited has a functional currency of US dollar and needs to translate its financial statement into the functional and presentation currency of XYZ Info Euro. Okay, so essentially my currency is US dollar and I need to translate into Euro. Okay. The following is the balance sheet of XYZ Global Limited prior to translation, right? Which is in US dollar. So property, plant and equipment, 60,000, receivable, 900,000, 9 lakh, total is 9,60,000. Then I have an issued capital of 40,000. There is a information given, the equivalent euro of for issued capital is 25,000. My opening retained earning, the equivalent opening retained earning in euro is 15,000. My profit for the year is 22,000. My accounts payable is 8,15,000. My accrued liability is 58,000. My total equity in liability is 9,60,000. Okay. So remember the rules, what I said is that for assets and liabilities, you will translate at the closing rate, right? For stockholders equity item, which is what you see here, capital and retained earning, that's a historical rate, and that historical values are given in the question itself. And then if you have a P&L item that you will translate, which is the profit for the year which is coming, that you will translate at the average rate. Okay, at the average rate ordinarily. Okay, let's look at more. I think there'll be more information here. Additional information, relevant exchange rates are now given here. Rate at the beginning of the year was Euro 1 equals to USD 1.25. Average rate is 1.2. So I need to translate into euros, right? And rate at the end of the year is 1.15. Okay, the closing rate is 1.15. You are required to translate the balance sheet of XYZ Global Limited into Euro, which is ready for consolidation by XYZ Info. Okay, share capital opening earnings have been calculated already. Prepare a working of the cumulative balance of the foreign currency translation reserve as per relevant Ind AS. Okay. So we have literally the balance sheet of this entity, which with the total assets and liabilities of 9,60,000. Okay. So I now need to do the translation of dollar into euro, and there are relevant rates which are already given in the question, fairly simple, right? And I said For balance sheet item, I'm going to do for the asset and liabilities, I'm going to translate the closing rate. So what is the closing rate here? Closing rate is 1.15. Okay. Now for the P&L item, I need to translate the average rate. What's the average rate here? Is 1.2, right? The closing rate is this. And is there a relevance of the rate at the beginning of the year? Generally, there is no relevance of the rate at the beginning of the year. The relevance of the rate at the beginning of the year is only to justify your currency translation reserve in a way from that perspective. So we will just try and understand how all of that in a way is happening here. Okay, how all of that in a way we need to justify. Okay. So now we also said the capital items at the historical rate for which the values are already given. So fairly simple question, right? There's no complexity to my mind in this question. So I'm going to look at the solution, translation of the balance sheet here, USD exchange rate and my euro. So 60,000 PPE, translate the closing exchange rate, receivable translated at the closing exchange rate. Total assets, it gives like 9,60,000 is my total assets, and they are also equivalent euros is what I'm getting, 8,34,783. Okay. And then on the issued capital, it's a historical rate, which is already given. Opening retained earning at 15,000. Now, during the year, I made 22,000 PNL, right? Which I'm going to translate at the average rate. This is the average rate. Okay. So I get 18,333 euros. Okay. And then the liabilities, right? Payable again at the closing rate, accrued liabilities at the closing rate. So this is nothing but the difference. So you have the asset side total, which is 8,34,783, and then that is what you get the total of the liability side, or liability plus equity, which is 834,783. And when you do the individual sum total of this, it will be short by 17,319, and 17,319 is actually the balancing figure. Okay, is the balancing figure, which is called foreign currency translation reserve. So that's one part of the problem which has now been solved, right? Foreign currency translation reserve. And remember, this is the closing rate, right? This is also the closing rate, which is the asset, and historical rate. This is the average rate, and again this is the closing rate, and this is the closing rate is what we have used for the purpose of translation. Okay. And the resultant difference, because I am not using, if you are using only one rate to translate everything, right? Because this balance sheet anyway was timed, right? If you were to use only one rate to translate, then this balance sheet will tie by default, right? Then you don't need to use any translation reserve, or no balancing number will come. Because we use multiple rate for translation, it results into a difference, and that difference is recognized as a foreign currency translation reserve. And now we need to just make sure that we check that this foreign currency translation reserve is actually reconciled to what we are trying to do. So how do you reconcile this? Okay. So what do we have here? We have the opening, and we have the closing, and we have the average. Okay. So the way you look at the reconciliation, okay, the issued capital, which was 25,000, right? If you, the difference, if you were to translate, okay, at the closing rate, that results a difference of 9,000. So essentially, now if you translate everything at the closing rate, what essentially it means, okay, because all assets are translated at the closing rate. Okay. So on the opening retained earning, if you again translate that at the closing rate, you get the difference is 6,739. Okay. That's how you're going to look at this. Okay. And then when you look at the difference here, right, which is profit for the year, and that also is translated at the average rate, whereas the assets which are generated because of this profit, they are translated at the closing rate, right? So essentially that gives a difference of 797. Okay. And the total amounts to 17,319. So this 9783 plus 6735 plus 797, that gives to 17,319 in a way from that perspective. Okay. So I'm hoping that this reconciliation, issued capital amount in euro, which was written, which is 40,000 in dollars, right? But the balance sheet amount was 25,000 only in euro. So if 40,000 translated the closing rate, that gives me a 34,000, right? 34,000 minus 25,000, it gives me a difference of 9,783. Similarly, the 25,000 of my retained earning, right? That gives me a difference. If I were to translate this at the closing rate, why I'm doing this at the closing rate? Because all my assets are translated at the closing rates. Okay, so and that is where the issue is actually coming. So there's never an issue on the asset side. The foreign currency translation reserve arises is because my equity items are translated at the historical rate and my P&L items are translated at the average rate. Okay, so that's what you're trying to bridge, that gap. And that delta, if you were to translate at the closing rate, everything, that is what we are trying to do here. So if capital I translated at the closing rate, I would have got 34,000 euros, which is where the balance is 25,000. So 9,783 is the difference. Similarly, for the retained earning, if I've translated this 25,000 at 1.15, I would have got 21,789 euros, right? But I have only have 15,000, which was the given information. So 6,739. And similarly, the 22,000, the profit which I made during the year, I have, if I were to translate at the closing rate, I would have got 19,130. But here I have done the translation at the average rate. 1.2 was the average rate. So this gives you a difference of 797. The sum total of all three is 17,319, which in a way gets reconciled to your, to the balance which was there in your euro balance sheet, right? The translated balance sheet, that was the reconciling number. Okay, all right.